Good afternoon. This is Mike Bertelson, the Bear Market Investor, with a market update for February 14, 2011. Now, I did not originally anticipate on creating a video this evening. It is St. Valentine's Day. I want to spend time with my family and kids. But at the same token, they have afforded me the opportunity to do so. They're out running some errands right now, so I do feel like I have a moment to do this. So I will be creating a short video. Now, this video is not like the others in that I'm just simply proposing a alternate wave structure that is probably becoming increasingly more likely than what I've suggested before. Now, both mean exactly the same thing and both count just fine, but you know, in terms of proportionality, I don't like to see fifth waves that are quite so extended as I was suggesting. Now, you know, that was fine probably right up until this point, and even perhaps right into here, but we've even got a couple days beyond that, and I'm starting to become a little bit more uncomfortable with the possibility that we're in such an extended fifth wave. But again, both of them really count just fine. It's just, you know, from a matter of proportionality, I want to propose this as well. Now, I had even proposed that this could have been a triangle right here, and that still is entirely legitimate. However, even though my original count did not have this as a triangle, either case in that original count or that original context is fine as well. But under this particular count that I'm going to propose to you, we would have a first wave really concluding at this level, a second wave. We would have a third wave. Remember that ending diagonal right here, again, concluding a third wave push. And that looks pretty nice to me at the moment and proportional. Not all the indicators agree in all the time frames. So the reason I backed up is because the wave structure is becoming so large. Or so extended, and sometimes it's worth backing up just to get a different feel on things rather than going into that 30-minute, 15-minute, and shorter time periods. But again, both count just fine, both mean the same thing. Then from there, that third wave concluding there, we did enter a fourth wave triangle. There is absolutely no other way that I can count this, and anybody that has this concluding a fourth wave here probably didn't count this in any shorter time frame, because it doesn't count. So this appears to be a fourth wave triangle. From there, we've thrusted into a fifth wave. So this just looks more proportional to me. I may end up going with that in the end because of that particular fact. But in either case, it leaves us very, very near a top here in the S&P 500 stock index under the count that has us completing wave 5 of C at near current levels. Now, I can't tell you that today concluded the rally because we haven't seen any pullback and we haven't seen any levels of support taken out. And again, as I've noted, degrees, fourth waves need to be taken out here. So on the next decline, I think it's important to regardless look at this fourth wave low right here. You know, whether or not we want to consider this fourth wave low also, if that is a fourth wave low, or if this is a fourth wave low in here, you know, is an academic exercise. However, both again have, you know, a large amount of merit to them. But, you know, we'd probably like to see both taken out just to be sure that that wasn't really an extended fifth wave and that we won't continue to subdivide higher from this fourth wave low right here. Again, ultimately, this needs to be taken out. But let's go ahead and jump over to the Volatility Index while we have a moment and just examine what's happened here today. Again, not a whole lot new, but I did note in the YouTube comments section that we did put in a reversal candlestick. Now, big picture here, going all the way back to that surge of volatility from the April 2010 sell-off, we had a surge up to form a larger descending area of resistance from the 2008 panic in through the April 2010 panic, and, you know, perhaps allowing the market to stay above water until the middle of the year. I don't think that under the current Elliott wave interpretation that's likely. However, there are other bearish Elliott wave counts that I've seen other Elliottians do that are certainly more complex than what I proposed to you, but would lead to a market sell-off and then a rally onto a new high. So even if we topped at current levels, they're suggesting that we would see probably a fairly substantial pullback and then a thrust into a new high, perhaps getting to that 78.6% Fibonacci on the S&P 500 before finally concluding. Now, again, back to the volatility index and that declining area of resistance here. That happens exactly coincide with that 78.6% retracement on the Fibonacci fan. Now, I am the only person, I hope, that you've probably seen that has this particular chart right here. I'm using this particular tool called the Fibonacci fan, which is something similar to what you might see with Fibonacci retracement levels or Fibonacci time relationships and things of that nature. Now, the way this works for me in this particular chart is I've drawn this line. Now, this line was an original breakout here of a little bullish falling wedge that we were in. And after that, we saw a surge. Well, now look what's happened. I did not draw these particular lines right here, yet these acted as support and resistance within the volatility index, as has this lower boundary, this longer-term ascending area of support, even though we broke in below it several times, and this horizontal level right here. But this is the 38.2% retracement on the Fibonacci fan. This is the 61.8% retracement on the Fibonacci fan. And look where that 78.6% retracement is on the Fibonacci fan. It's back here, exactly coinciding with that longer-term declining area of resistance on the volatility index. Very interesting, but I don't think coincidental in that I do believe that there is something behind all of these particular things that we're seeing, whether it be this particular retracement level exactly falling in line with that declining area of resistance or anything else to that matter. Whether you look at Fibonacci retracement levels and market turning points and things of that nature, there is something deeper inside the markets, and this is probably representative of that. Now, ultimately what we want to see is we want to see a surge that pushes through horizontal levels of resistance as well as these declining areas of resistance. But as I noted, due to how far out this could potentially draw us, even if we didn't break this horizontal level of support here, we could see this market hold up that line, but we ultimately want to see us thrust through these, and then that's going to get me really bearish at that point when we see a convincing thrust beyond those areas of resistance, particularly the 78.6% retracement on the Fibonacci fan. And we're looking for that surge under the current Elliott wave interpretation to occur very, very soon. Now, even if we get that surge and the market, the count is actually correct, we could see a surge followed by a pullback to lower levels to back test that, putting in a second wave high on the S&P 500 before a third wave surge in volatility erupts. So there's many different ways of looking at what could potentially happen within the volatility index, but it's important to take that into context of our overall Elliott wave structure within the S&P 500 that I proposed to you here. So again, we're looking for surges to thrust beyond those resistance levels in the volatility index, which will help confirm to us that we are really resuming the bear market rather than just correcting before moving higher. Now again, all of this suggests we're still in a bear market. I'm not proposing to you the bullish count in terms of Elliott wave count on the S&P 500 because I don't buy it, but as I've noted in the past. But there are a number of different ways we could get to the end result, and we have to look at what looks best right now, and that is that wave structure that I proposed to you in the past, as well as even in the context of the fifth of C that I proposed to you today or before today. So in either case, that still inevitably leads us to a top at near current levels, suggesting that we will see a surge, maybe even one that eventually breaks through this, back testing it, then surges on higher. So remains to be seen. Hopefully I have more to add later on this week with regard to today's price action, and perhaps tomorrow. We would ultimately like to see a top perhaps put in this week, or at least something that we could consider as at least a short-term top, and begin to see areas of support in the S&P 500 taken out, helping confirm that a longer-term top has in fact been put in place. If you wouldn't mind, please rate the video. I appreciate it. Have a great night.